Hi friends, in this video I am going to share with you 3 stocks that can potentially double in the next 2 years.
पैसा ही पैसा होगा.
Without wasting any time, I want to come straight to the point, and the first stock that I am going to talk about is Sterling Tools Limited. Have a look at my screen and you will see that this stock in the last 1 year has given close to 72% returns already. Immediate question may be that Rahul, in the last 1 year the stock has already given 72% returns. So is there any more upside left in this stock or not? This is an excellent question and let me answer that question first. So what you see here is that if we come down, have a look at the PE of this stock right now. It is at around 27 and PB is at 3.29. From a sector perspective, if we see, the PE is 44 and PB is 5.29. So there is a lot of room still left even if the Sterling Tools get to the sector level of KPI in terms of PE and PB ratio from a valuation perspective. But I believe that this stock will do much better than the sector. In fact, it is going to enjoy the premium when it comes to the valuation side. Also, before I talk about why that is the case, let me also share with you the PE track record of this stock. What you see on my screen is the median PE typically in the last 5 years for this stock has been around 25. Right now it is at 26, slightly higher than the median PE. But if you look at October 2020, you will see that the PE was close to 55. So it has gone and beaten the sector PE by a good 10 basis point, and I believe that this stock has the potential to go back to the 55 PE level. Therefore, a great chance to get doubled in the next 2 years. Now let me present to you why I believe that the stock can be double from here with some data points. So what you see on my screen is that Sterling Tools operate mainly in 2 business lines. Number 1 is fasteners, which are used for any type of machineries to work, and number 2 is EV component, which is MCU. Please Google what MCU is. It is an integral part of any EV vehicle. Second business that they are in is that they manufacture MCUs. Let me first talk about their EV business and why this company is going to rock like anything when it comes to EV business. So what you see on my screen is their consolidated profit and loss statement for Q1 of 2023-24, and you see that total income is close to 222 crores in a quarter. But since this is the consolidated profit and loss, we do not know how much of this is from the EV business. So for this, I looked at their earnings call presentation and someone actually asked this question. Have a look at my screen and you will see that. And their CFO Pankaj Gupta said that the current turnover of the EV business right now is 38 crore in the Q1. And if I do the simple maths, you will see that 38 divided by 222. So close to 70% of their business is coming from their EV business. But more importantly, the MCUs that they make in the EV business, they are the sole suppliers of majority of their customers. So for example, have a look at this commentary here from their earnings call. You will see that Jaideep Wadhwa, who is one of the directors in the company, clearly mentioned that they are the sole suppliers for many of those customers. And if a customer like Ola Electric, for example, need a MCU supplier, it takes at least 6 months to 12 months to get a new supplier onboarded. So right now, from that perspective, they are the sole suppliers for many of their customers. Ola Electric is one of their customers, and I will share with you in terms of the risks that they carry. But right now you see, because of the monopoly, almost a monopoly that they have with their standing customers, their business, which is EV business, is going to boom like anything. Second important point from their EV business perspective is that they are already at break even from an EV business perspective. Many companies right now are making losses in EV business because there is a lot of upfront investment required. It takes quarters and years to start becoming profitable. But this company right now is already breaking even when it comes to EV business. Have a look at my screen. You see that their break even is close to 10 crore a month, and in the last quarter, as we saw, they have done already 38 crores, meaning that they are already breaking even from a EV business perspective. Point number 3 from their EV business perspective is that, have a look at my screen, their pending order book on the EV side is close to 200 crores already. What it tells us is there is a significant growth that is going to come from their EV business, and we can see this in the numbers as well. Have a look at my screen again. You will see that the standalone business numbers are on the top and the consolidated business are on the bottom side. Standalone simply means their fastener business, and consolidated means that their fastener plus EV business plus any other incomes that they may have. And if you look at the numbers, you will see that in 2022, if you see, the total standalone business was 475 crores. But in consolidated terms, it is only 513. So roughly 37 crores of additional business coming from EV business plus other streams. But if you see 2023, the contribution of their EV business has grown up by almost 28%. So there is a lot of growth that is happening in their EV business that is going to drive their profitability as well as revenues in the upcoming quarters. And if we were to listen to their management in terms of the growth prospectus from their EV business perspective, what they are clearly saying is that they are looking at generating close to 300 crore rupees of business just from their EV business. Let me now quickly talk about their fastener business, which is where right now they are getting 83% of their revenues. What you see on my screen is their fastener business is what I call is into diversified niche. Now you may question my statement of diversified niche. Rahul, at one hand you are saying it is diversified, on the other hand you are saying it's a niche.
अरे कहना क्या चाहते हो?
Let me quickly explain. What I mean by niche is that they produce fasteners for only automotive industries. While the fasteners are used in almost every industry where the manufacturing is happening, even textiles have it, automotives have it, steel making has it. Everywhere there is a machinery, you will have fasteners. If you have engineering background, you will easily understand that. But since they only supply fasteners for automotive industry, they have created a niche for themselves. But the second point is why I am calling them diversified business, because if you look at the screen, you will see that within the auto industry, they are very well diversified. If you see this, that passenger vehicle, for example, is 27% of their revenues. From a two-wheeler perspective, they have 21%. From a commercial vehicle perspective, 24%, and so on. So my point is that even if one of the sub-segments within the auto industry does not perform well in a particular quarter or year, this company is well poised to take care of that risk from fasteners business perspective. Second point around their fastener business is that this business is a cash cow, giving them very good bottom line, because when you see the numbers, have a look at this number, you will see that from a standalone perspective, their EBITDA is at 15.3%. But if you look at the consolidated perspective, it is actually coming down. So EV business right now is dragging their EBITDA margin slightly down. That tells me that their fastener business, which is right now 80% of their business, is actually a solid bottom line generating business. And I call this as a cash cow business, which has limited risk right now because it is well diversified. The next point that I want to talk about in terms of the upcoming growth in this business is, have a look at my screen, you will see that in the Q1 of 2023-2024, steel prices actually fell down by close to 15 to 20% if you look at this commentary here, and we are going to see the impact of that in the upcoming Q2 and Q3 potentially. And what that will do is that the input cost is going to come down. That means that the company is going to enjoy a little bit more profit. Hence, the earnings of this company in the Q2 and Q3 from an input cost perspective is going to go up. And the last point that I want to share with you around the growth story for this company is the automotive sector itself. If you read the commentary from Atul Agrawal here, one of their management team member, you will see that FY 2018 and 2019 was the prime or the good year from a automotive industry perspective. We right now have not even gone back to that level, because if you read the numbers, they say that even two-wheeler business is right now still 40% negative from that peak. Commercial vehicles are close to 65%, 70% level of that peak. So my point is that automotive sector has got a lot of room to grow next coming years, because we have not gone to the peak levels just yet. And more importantly, their EV business is already breaking even. In fact, showing great signs of good backlog, healthy backlog, and their fastener business overall is enjoying good growth as well as good bottom line. And lastly, because the steel prices are lower, what it really means is that business is going to give us really good quarters in the next few years, meaning that in the next 2 years, there is a lot of potential for this stock to go double from here. Since I've presented to you a lot of positives about the company, let me also talk about one of the biggest risks that we can see from this business so that we understand the risk as well. What you see on my screen is one of their customers from an EV perspective is Ola Electric. You can see that on my screen in their earnings call presentation. And right now, for example, in Q1, the Ola Electric orders were down for whatever reason. And that is one of the big risks that you need to understand, that they are heavily reliant on the OEMs from the automotive sector. And for whatever reasons, if the customers stop selling vehicles, then their business is going to get negatively impacted. So there is always a chance that couple of quarters or 1 quarter here and there, they might not perform well. Please do not panic. And I think all of us must take that risk into consideration, that if that risk plays out, the quarterly revenues or the yearly revenues might see slight dip. And therefore, we must consider this risk as well while taking any investment decisions. Before I move to stock number 2, let me also give you a disclaimer that this stock is very risky because it's a small cap stock. And before you take any positions in the stock, please make sure you do your own research. Do not go by what I am saying. I am simply presenting you my analysis that you can use as an information, and you must do your own research. But if you like this analysis, I request you to hit the like button. Also, you can consider subscribing to my YouTube member community because I post exclusive in-depth stock analysis as well as mutual fund analysis on my member community, and you might find that content helpful for you to make investing decisions. The second stock that I would like to analyze and share with you is from the infrastructure sector. Have a look at my screen. The name of the company is J. Kumar Infra Projects Limited. In the last 1 year, the stock has given close to 50% returns that you can see on my screen. And again, the question is whether there is any upside remaining in the next 2 years. So if you look at the PE and PB numbers, you will see that PE ratio right now is around 10.87 here, while the sector PE is 44. Even though the stock has given close to 50% return in just last 1 year, we can see that there is a lot of room from a PE and PB perspective for this company to grow, because this is still a small cap growing stock. Also, if I show you the PE number from a median perspective, the median PE of this company is 7.7. Right now it is trading at around 10. And if you look at the high PE, it was at around June 2021, and you see the PE was at around 21. So there is definitely a potential upside for this company's PE to go back to 21 at some point in time in the next 2 years. And for this, let me also present to you some important facts from their earnings presentation call. So if you look at the numbers, you will see that from a revenues perspective, close to 52% revenues come from metro development, and 42% is the next number that comes from flyover, bridges, roads and tunnels, etc. But more importantly, the reason I think the company is going to do really well in the next 2 years, this is because the order book breakup. So if you see on my screen that they currently have order book of close to 14,000 crore rupees. Now this is very, very important, because if you look at the revenues of this company, so if we come and have a look at the financials of this company, we will see that currently the run rate of this company from a revenue perspective is close to 4,200 crores. And if you look at the order backlog here, we will see that the order backlog is close to 14,000 crores. So meaning that they already have an order backlog of potentially 3.5 times that is already there. And if you look at this order book, these are not the orders in the pipelines, they are the orders which are, they have got LOA, meaning letter of authorization. So meaning that they have bagged these projects already, and in the next couple of years, 3 years, 4 years time period, they are going to execute these orders. Point number 2 is, if you look at their recent win, because it's also important that we need to see that they are continuously pouring into this order backlog. So if you look at the win for 2024, you will see that they have won this project, elevated corridor from Chennai port to Madurai. So if I show you on the map, this is from Chennai port to Madurai, a place where there is going to be a 4-lane elevated corridor that they've won the project for. And this project itself is worth, if I look at their order book, it is close to 3,570 crores. So recently also they have won the projects. This is going to be at a large scale. Also point number 3 is that if we look at their earnings presentations commentary, we see that the company is expecting to get close to 8,000 crore rupees of orders in the financial year as well. So there is more to come here. Lastly, from a growth perspective, what we see here is that the company wants to achieve $1 billion target by FY27. And their management team, so Kamal J. Gupta here has given a precise commentary about how the company is going to achieve this number. And what they're precisely saying here is that FY25 and 26 is where they're expecting 18% to 20% growth. Again, this is a good set of number and growth that the company is forecasting right now. However, as all of us are also aware that in infrastructure sector, what really also matters is the debt and working capital. So if you look at the debt profile of the company, we will notice that from a debt equity ratio perspective, in the last few years it has been declining, meaning that their balance sheet is potentially looking much healthier from where it was 3 to 4 years ago. Having said that, what are the key risks that we need to understand from this company's perspective? So have a look at my screen. The first big risk is that NHAI, which is National Highway Authority of India, the organization that provide the construction work to companies like JK Infra. What right now is happening is, if you look at this chart, you will see that the interest that they are paying is very high. It's growing at a higher speed than their toll collection that they are getting. And as a result, there is a lot of pressure on NHAI from government's perspective that you have to start monetizing your assets. And they have a target of 160,000 crores of monetization, the road asset monetization that NHAI has to achieve. And the risk here is that If NHAI is not able to achieve this target, then what is likely to happen is there are two outcomes possible. Either government will have to step in and fund this money, or government will stop pumping money into the infrastructure work. Therefore, there is a risk that JK Infra and other infrastructure company may not get more work in the coming years, and that may have a severe impact in their revenues and profits. So we need to understand this risk as well, because nobody can really predict future here, and we need to really go with open eyes, because we are talking about doubling our money. At the same time, we also need to understand that our invested money can go to literally zero because of the risk that I'm talking about. The second big risk that companies like JK Infra carries is, have a look at my screen and you will see in September 2021 there was a news that under construction bridge collapsed in BKC, and JK Infra was the company that was building that bridge, and as a result what can happen is that the share prices can come down drastically because of any mishaps that might happen during these constructions. Also, if you want to get quality information and analysis on individual stocks so that you can make better informed decisions, you can consider subscribing to my YouTube member community, because I post detailed exclusive content only for my YouTube member community. The third stock that I want to share with you is Karnataka Bank. So have a look at my screen. You will see that Karnataka Bank Limited in the last 1 year has given close to 200% returns already. Again, the same question comes that is there any upside left in this stock or not? Have a look at the PE and PB ratio both, and you will see that from a sector perspective, it is still far behind. Even if it were to catch up at a sector level, there is a lot of room for the upside for this stock. If you look at the peers, you will see again from Karnataka Bank's perspective, it is still far behind from a valuation perspective. If you look at the numbers of this bank, we will see that from a growth perspective, last 1 year the company has done phenomenally well. If you see the numbers here, if you look at the net income, 132% growth in just last 1 year, and that is what has been reflected in the share prices. From a PE perspective, if you look at the trend here, you will see that in the last 5 years the average median PE has been 4.6. Right now the company is at around 5.2. I know from banking perspective PE might not give you everything that you need, but relative to where it was trading few years ago, in terms of where it is right now, it also talks about the valuation side of the bank. But more importantly, if I show you the numbers and certain KPIs that the banks measure, have a look at my screen and you will see that from a financial highlights perspective, I've taken the last quarter's result, Q1 2023-4. You will see that they have done improvement in almost all the important parameters and metrics here. If I were to call out some of them, you will see that from a return on assets perspective, the company is giving right now 1.47%. It is extremely high. If I put this in context of SBI, and if I show you SBI's chart, right now SBI's ROA is at 1.22. So from a ROA perspective, it is even beating right now SBI. And also if you look at other factors such as NIM, net interest margin percentage, it is at 3.68%, gone up from 3.33%. This is a very good improvement. And you know right now, for example, companies like HDFC that has got the lower NIM because of the merger, while Karnataka Bank and the smaller banks are showing really great improvements in some of those metrics. You can read all these metrics. They are all important numbers for you to understand. Another important point about Karnataka Bank is that as the bank completes 100th year, the company's management is changing the mindset of the bank, and they are calling this as a startup at 100th year. Again, quite an important point from a culture perspective that we need to understand. If a bank has to grow, they need to be agile, they need to be technology led in today's world. So I see that Karnataka Bank is taking that path, which is extremely important from a traditional banking perspective. Also, if you look at the focus areas, they are focusing on retail, as many other banks like even IDFC Bank started focusing more on retail. So they are focusing on retail, and secondly they are also focusing on rural and MSME. And if I show you the breakup, because MSME, which is micro, small and medium enterprises loan perspective, they are close to 24% of their loan book is there, and from an agriculture perspective 13%. These two segments are really important from Karnataka Bank's perspective because they are the core businesses for Karnataka Bank. Not only that, they are also focusing on retail now. That is going to give this bank a well diversified loan book. Also, another important point that we need to also consider is that their new management team. So very recently, Shri Krishnan H has been appointed as the MD and CEO of this bank only 2 months ago. So some of the key roles in the management team is brand new, and I think there is a risk here. and also an opportunity here. From an opportunity perspective, new team can take this bank to a new heights, but at the same time, the risk is that this management team is fairly new, may not understand the culture of the bank, and may take some time for this bank to grow. Again, this might be a risk that I need to qualify here. All in all, from my perspective, I see Karnataka Bank growing at a really good rate in the next 2 years and have a good potential to get double from here on. I would love to know from you, which stocks do you think is going to double in the next 2 to 3 years from your analysis perspective? Let me know in the comments. Also, let me know in the comments any stocks that you would like me to analyze and present you the information, potentially saving you some time, and I'll be happy to shoot that video. A big disclaimer, please do not invest blindly in any of these 3 stocks that I've talked about in this company. Please make sure you do your own individual research, because at the end of the day, it is your money. You will get profit, you will get loss. Please make sure you do your own due diligence and use this as a information only, and do not take the decision based on this information. Lastly, you can also consider subscribing to my YouTube member community, because that is where I post exclusive in-depth analysis on stocks, mutual funds, and various other assets, and you will get benefited from that. With that, I hope to see you in my next video. Until then, keep rocking.